Hello and welcome to Charting the Markets. We've seen a topsy-turvy 24 hours with the UK jobs data coming out ahead of the US inflation readings. And today we've seen the focus back to the UK with the UK CPI readings. And this has been a really important one. Yesterday we saw a slowdown in terms of the decline for US inflation. But in the UK, we've now seen a pickup in that decline. I mean, we needed it, quite frankly, because we're still in double-digit inflation on a headline basis. But nonetheless, this decline that took us down to 10.1 does show that we're finally starting to ramp up that downside move in terms of UK inflation, and emboldens those that believe that soon enough we could see the Bank of England reverse course, or at least stop this upward trajectory in terms of interest rates and move towards that terminal rate and then ultimately towards cutting interest rates. Look, when we're seeing the IMF and the Bank of England both agree that we're going to see UK growth over the course of 2023, really underperform pretty much the rest of the world, there is likely to be a need for the Bank of England to try and be accommodative where possible. They don't necessarily want to damage the economy, but the primary objective is bringing down inflation. Without inflation coming down, they don't get the opportunity to do much, really. And so today's reading really is significant at that. Just wanted to also highlight what we saw in terms of the core figure, because we've also seen on the month-on-month basis a 0.9% decline in the core inflation rate. And certainly it's notable that we're seeing downside in terms of inflation across headline, across core, across services, across manufacturing. So really it's very widespread. One key thing to note across both the UK and the US figures is that it's heavily dominated by housing costs. Over in the US, we're talking about shelter. Over in the UK, it's more just housing services. In the UK, the big determinant, one big sort of mover within the housing costs area has been energy prices. And with the fact that we've seen sort of nat gas prices moving towards the downside in a pretty dramatic way, energy prices moving lower, you're waiting really for those energy firms to start driving down the costs for households and businesses. And that then should feed through quite heavily in terms of the inflation figures. So arguably it's interesting for your own finances, but also that of the wider sort of UK inflation picture, to wait for when we see those energy prices start to come down. And that's when we should likely see a ramp up in terms of the downside movement that we have been seeing playing out today. In terms of the indices space, we have seen the likes of the FTSE 100 moving towards the downside, but that looks like it could be brought up soon enough. Bear in mind, the move that we've seen in terms of UK inflation today does signal the possibility that we could see the Bank of England not raise rates next time around. I mean, markets still see a majority sort of view that they will, but nonetheless, that sort of shift does factor into market sentiment. So slightly potentially more dovish outlook from the Bank of England, that would be positive for stocks. What we've seen here in terms of the FTSE 100 is a pullback over the course of the past 24 hours, but that's taken us back towards this wider ascending trend line. Bear in mind, it's only a provisional trend line because we have only got 2 touches, but nonetheless, it shows you the trend that we're within, and that is a bullish trend. Now, more recently, we've seen this push towards the upside that's then given us a retracement. That retracement thus far is only taken into the 50% level. So, maybe we see further downside. Maybe we see us hit 61.8 and trendline support. Ultimately, whatever we do here, it does look likely that this is going to be a short-term phenomenon before we see the bulls come back into play once again. 78.49 is the key level to watch out for here. A move below that level points towards a wider sell-off for this market. I don't necessarily think that's warranted. If we were to close this candle with a sort of long lower shadow, then it could point towards this being a bottom before we push higher once again. If you look at the sort of previous occasion that we've seen this doji candle back down here, and then we ultimately pushed higher from there. So there's a chance we could see something similar, but for me, I think there's a strong chance that the declines that we're seeing at the moment are simply a precursor to us pushing upwards once again, with a breakthrough 78.49 required to negate that view for a market that has been a big outperformer, pushing into record highs on a similarly daily basis at the moment. In terms of Germany, not necessarily seeing those same highs as the UK, but we have been seeing significant gains over the past 4 to 5 months. More recently, seeing consolidation, or where the FTSE 100 has been moving higher. Now, this points towards a likely resolution towards the upside, because if you look at, the last time that we've seen this, it's this area here. So if we were to take a box, you could say, this area of consolidation, and let's just draw that back here. So we've got this zone, we then push towards the upside. We're now into a new zone. So we've got it somewhere like that, right? So this is just another consolidation phase set within a bullish trend. Now, what would we need to see before we start looking for a wider bearish picture? Well, anything that we see play out around this zone, for me, looks like a retracement. And so we're looking here in terms of this retracement and saying, well, as things stand, it looks like we've pretty much come into and around that 61.8 fib. Interestingly, we've come in, excuse me, around what was the prior peak. So we've got this zone of sort of prior resistance turning support, also the 61.8 fib. So, any near-term downsides likely to find support around that 151.90 to 152.72. But ultimately, even if we drop below that, we'd still be looking at this as a deep retracement, 150.81 being the next support level beyond that. 149.03 is the line in the sand. Until we break that level, then anything we see here is essentially a retracement of the latest leg higher. So for me, near-term downside is there to be bought into. A break below 149.03 negates that, but until that happens, it looks likely that this is a precursor for us to then soon enough start to push towards the upside once again. And then looking at the US Tech 100, the NASDAQ index, let's look at the weekly time frame first and foremost. What we can see here is this wider bearish trend. We did see this latest pop in the double bottom formation, but as I highlighted previously, we didn't necessarily break into a new low. So that means that the key swing high is still 137.22. The wider picture does highlight this ascending trend line. So there is a good chance that we have bottomed out here. But as it stands, we've turned around at this 76.4 Fibonacci, which points towards a potential for us to be in another retracement. We've seen some initial downside, but now starting to strengthen. So I think it's important to just drill down into near-term price action and see exactly how things are playing out. So here's how things are playing out over the near term. We can see this latest pullback looks like it's currently still just a retracement. Let's see exactly where we've come into. So we've come into the 61.8 fib, tagged it perfectly, bullish engulfing candlestick, and we're starting to move higher from there. Onto the 4-hour chart. So within this latest pullback, you can see this clear trend of lower highs and lower lows. The lower lows are important. Like I said, that came into the 61.8 fib, as we can see here. But the more important part is the lower highs. If we manage to break the most recent swing high, that would be the 127.76 level, then this pattern of lower highs and lower lows is over, and we'll be looking to push onwards and upwards once again. Until that happens, this current rebound has taken us into the 76.4 Fibonacci level, and we've perfectly respected that. So lots of fibs being drawn on here. So we've got a near-term intraday downtrend. We've respected the Fibonacci level. That points towards the potential for another move towards the downside over the near term. If we were to break the 127.76, that negates that, and it continues the bullish trajectory that we have been seeing over the course of 2023 thus far. Looking at the FX space, I wanted to have a particular focus on the pound in the wake of the latest UK CPI readings, where we did see a downside move over and above what markets were expecting in terms of both headline and core inflation. That has seen the pound weaken as we see expectations of the Bank of England raising rates, easing somewhat. And crucially for me, this marks a turnaround in particular for cable. The daily time frame is the important one here to really sort of base things upon. We can see a very clear bullish trend here. You know, we're within that next sort of phase of upside move here, and we can see here we've seen the pullback, we've seen the rally, the pullback into the 76.4 Fibonacci level. We tagged it yesterday, and I wrote a piece talking about, you know, how things sort of lay of the land in the follow through on the UK jobs market, the US CPI, and leading into today's CPI, and saying this is likely to really set the precedent for where we go going forward. That's exactly what's happened, because what we've seen is we've tagged the 76.4 fib. We've got a bullish trend in play. We're now pretty much guaranteed to see a bullish engulfing candlestick formation. And into the 4-hour chart, we can see here the breakthrough trendline resistance, but crucially, the hourly time frame gives us clarity over, let me just get rid of one of these trend lines, this pattern of lower highs and lower lows, now negated with a breakthrough 88.48. That signals the bottom for me. I don't expect to see us break back below this 88.03. So with that breakthrough 88.48, the bullish picture is now engaged once again. So I'm expecting to see further upside as we look to continue that bullish uptrend that we have been seeing playing out over much of the last 6-7 months for euro sterling. In terms of cable, we're seeing that weakness playing out, but interestingly, this is a market that, you know, maybe we could see it top out, but it's been taking a bit of time here. We've got this potential double top formation, given the fact that we failed to break the prior high here at 124.46. So it could be a very nice double top formation. Let's see if it will be playing out. Let's see, it broke around about sort of 37 bars, almost 2 months. So over here, you'd be looking at potential for a break at the back end of this month. You know, that kind of tallies up. At the moment, it looks like, you know, we have been regaining ground. But for me, I think there's a good chance that this, you know, if you look at the steep decline coming into this phase, that dramatic sell-off and then this very gradual regaining of ground, that doesn't fill me with confidence that we're ultimately going to break the 124.47 mark. Instead, it looks likely that this will ultimately falter once again. This is sort of a retracement phase and a continuation move. 4-hour chart should give us greater clarity on that. You can see here we're creating this higher highs and higher lows. We've come in towards and below the 76.4 fib at 120.87. So we really need to turn upwards here if we are to maintain this recent trajectory. To the downside, 120.31 is the level we need to look out for. If we break that level, then this phase is over, and then we look like the bears are back in play once again. Let's see. From a Fibonacci perspective, we moved into the sort of deep Fibonacci retracement zone. Let's see if we draw it from that top end. Then we take the 61.8 perfectly on that sort of wider perspective. So it's a good chance that this retracement phase is over. But certainly a move through 120.31 would give us greater confidence that we are going to see the bears back in charge. And a similar kind of theme here in terms of the Aussie dollar, the daily time frame. We can see here, bullish trend took us into 71.37, rejected with a big seller from there, and crucially moved out of this pattern of lower highs. Now, that's more evident on the 4-hour chart because we can see here that 69.84 broke. Now we're seeing this upward sort of what I think is a retracement move, much like what I said we were seeing in cable. We haven't hit that 61.8 on this occasion, but we've now moved right into that 68.90. So are we creating this high highs and high lows? Well, soon enough, we could be seeing a new lower low. That could signal the beginning of that next leg lower to build on the sell-off that we saw at the beginning of this month. So look out for 68.90. If we break through that level, looks like the bears are going to be back in charge once again. Until that happens, there is still a chance that we do pop from here. But, you know, in terms of retracement, this is about as deep as you're going to get for the Aussie dollar. Looking at the commodities space, gold has been underperforming of late. Generally, you have a close link up between the US dollar and gold. And certainly if we are to see the US dollar strengthening, you're likely to see gold coming under pressure. Well, there is expectations that we could see the US dollar strengthening. We're not necessarily seeing it at the moment. Certainly, if you look at, say, the dollar index, we've been seeing it largely flatlining of late. But gold has been leading away. We're not necessarily seeing gold waiting around. We're seeing it selling off despite the fact that we're seeing that consolidation for the US dollar. And you can see here the big decline that we saw at the beginning of the month moved into a consolidation, the retracement phase. The breakdown through 1861 sees us back on our way, heading lower once again. I want to draw you to this weekly time frame, though, because what we have seen is an almighty run up over the course of the past 3 months. And so we've still got plenty of room towards the downside to move into. For me, I think this is going to be a big performer, this market, when we get towards the period where maybe inflation's in the position that allows central banks to start talking about how they would be able to provide more sort of accommodative monetary policy to help the economy. You know, maybe if we start talking about cutting interest rates, that's when we start seeing this really ramp up. You know, something I've mentioned a number of times in the past is these previous periods where we've, in particular in sort of 2001 and this move that we saw here in 2019, where we saw multi-year consolidation end at periods where we're seeing interest rates cut. Multi-year consolidation, interest rate cut. This one came in the middle of a move. So I think there's a good chance that this is the consolidation. And when we do see those interest rates cut, that's when we see gold really outperform. The caveat over the near term is we could then see further consolidation because we're not about to see interest rates cut. We don't necessarily know how long this is going to last for. And so I wouldn't be surprised to see further downside and significant downside playing out here for gold. So we're seeing some weakness here. The near-term support comes at 1825. Below that, if we look at the daily time frame, we could be looking at this wider retracement. So 1815, 1781 are the significant support levels. But I do think there's a good chance that we've got plenty of downside to come for this market as we give back some of the sort of significant gains that we've seen coming from Q4 of last year and moving into the beginning of this year for gold. Towards the upside, we'd need to see a break up through this recent swing high of 1890 to provide that more positive outlook. And then finally, looking at Brent crude, this is our trade of the week for the week ahead. And we're looking here at a downtrend that's been playing out for the best part of a year, quite frankly, more recently rallying back up into this confluence of Fibonacci and trendline resistance. The trendline resistance we can see very clearly on this daily time frame. The Fibonacci, I just wanted to show you here, comes with this perfect 76.4 fib that at the moment is being respected very well. Let me get rid of the 61.8 to clear it up. And we can see here, we've tagged it 2 days in a row, and now we're moving lower once again. So there's a good chance that we do see this market roll over from here. The caveat is that, well, you're looking at this recent phase and we have been seeing higher highs and higher lows. So we're hoping that this trend line kicks in here. And at the moment, that's how it looks. Certainly greater confidence would come with a breakdown through your near-term support level, which would be your 82.94. If we break 82.94, then it gives us greater confidence that this phase is over and that the bears are really going to be back in charge for a move back down towards your 79.04 level for Brent crude. That's it for today. If you want any more news and analysis, make sure to go onto the IG platform. Other than that, follow me on Twitter. My name's Josh Money here at IG. Have a great day and good luck trading. Thank you.